The falling price of the US dollar has been in the news a lot recently. And it's more than just the fact that it was down 10% in 2025 as an asset class. It has huge implications for what that means for the US economy. That's what we're going to talk about today. We're going to talk about the trade-offs or the implications of currency strength. So, what are the basic trade-offs between a weak domestic currency and a strong domestic currency, specifically when we talk about the USD? So, here I have two charts, both are the US dollar index. On the left is a zoomed out chart going back to the global financial crisis. As you can see, the US dollar has been relatively strong during that period. As globalization has increased, it has become the global reserve currency, which has helped increase its strength on the global scale. That has some benefits and that has some trade-offs, as we'll cover in this video. But more recently, why it's been in the tension, why the US dollar has been in the news, is that it's been slumping. As you can see from the chart on the right, a more zoomed in picture of its more recent price action. It fell almost 10% last year. So again, long-term, US dollar has been really strong. More recently, the US dollar has weakened somewhat significantly. So let's talk about what that means. We'll start with the stronger US dollar because that's been more of the long-term trend. And there's a trade-off for having a strong currency. So the upside, as you can see from the chart on the left here, is that it leads to lower import prices. Now the chart is a little bit confusing, but the US dollar in red here is actually inverted. So when it's moving higher on the chart, that actually means it's weakening. So when it moves higher on the chart, the US dollar is weakening. And you can see the blue line at that point, the import prices, that actually increases. So I did a little scenario here on the right to help explain this because the chart can be a little bit confusing. So let's say I'm a US importer and the current exchange rate is 1 USD for 1 euro. Now I obviously made up these numbers. I, as the US importer, am importing a car part that costs 1 euro from Germany. So typically, I would exchange 1 USD for 1 euro and purchase the part. Simple. However, now we introduced a new exchange rate. 1 US dollar is now worth 2 euros. So with that same US dollar, I can now buy a second euro. So the US dollar has strengthened relative to the euro. So now, if we look, I still need that one car part, right? Nothing has changed about that car part. It still costs 1 euro from the German exporter. But now, I only have to exchange a half of a US dollar, or 50 cents, for 1 euro and purchase the part. So me, as the US importer, because the US dollar strengthened, I can now import the one part that I need cheaper than I could before. And this is what we've seen happen over the previous decades. The US has been able to, in part because of the dollar strength, import cheaper and cheaper either final goods or parts for production. And that has benefited US companies largely. But there's a trade-off here. A stronger dollar, if imports get better, a stronger dollar is going to lead to less competitive exports on that same token. So we just flip it. There is a downside. So if we're going to look at this chart on the left here, again, the US dollar is inverted. So when it's moving up on the chart, it is weakening. And as you can see, when it moves up on the chart, this is the ISM new export orders. We see increased export orders. So again, a weaker dollar, more exports. Our exports become more competitive on the global scale. So now let's do a second example. This is scenario 2. Everything's going to be the same, except this time we are the exporter. So we'll start with 1 USD to 1 euro, but we are now exporting a car part that costs 1 USD to Germany. The German importer exchanges 1 euro for 1 USD, and they buy the part from us. And now we see the same move as the last scenario. So the USD strengthens against the euro. 1 USD is now worth 2 euro. However, the car part still costs 1 USD for Germany. But now they have to exchange 2 euros for 1 USD and purchase the part. So previously, the German importer could buy from us for 1 euro, but now, because of currency changes, because the USD strengthened in this scenario, they now must exchange 2 euros. So what can happen now is the German importer, if this is a product that can be produced elsewhere, let's say for 1.2 euros, instead of continuing to work with the US importer, they might look for a different solution instead of having to pay the 2 euros. And so this chart here sort of puts both of these trade-offs together. So we have the US dollar in blue against an index of consumer sentiment versus export manufacturing sentiment. So again, we'll start on the left here. Higher USD equals lower import prices equals happy consumer. So when the blue line moves up, you see that consumer sentiment rises relative to export manufacturing sentiment. And then on the flip side, we have lower USD equals more competitive exports, equals happy manufacturers. So when the blue line is moving down, we see the red line also moves down. So consumers are getting less happy relative to exporters, or said more naturally, the exporters are getting more happy compared to consumers. So the question becomes, is devaluing the US dollar, which is what we've seen recently, some of that is because of stuff we're doing, some of that is because of the new global financial order, you might say. Is that a smart thing to do? Does the US benefit from having a weaker currency? Well, on the surface, it's pretty clear that that's probably not the case. So I didn't include the pie chart that I normally include here. So points for me. I'm going to do the bar chart version. Consumption is almost 70% of US GDP in the US. So US consumers benefit a lot, as we saw from that double trade-off chart, from lower import prices. And that in turn helps grow US GDP because consumption dominates the US economy. You've heard the phrase, don't bet against the US consumer. That's because it is the main driver of US GDP. And they benefit from lower import prices and therefore a stronger currency. So the US consumer has benefited greatly since the global financial crisis because of how strong the US dollar has been. A weak currency is more important in export-driven economies, and that's just not what you see here in the US. I know this is rapidly changing as we sort of reorder our economy in a way. We'll see if that sticks. But exports and imports are just not a major factor in US GDP right now. And this just sort of shows the scale of how much consumption dominates in the United States. So this is the difference between consumption and exports by country. There's a ton, hundreds of countries in between where the two lines split, but it's just not that interesting. So I wanted to show you the extremes on the end. So the US is a consumer-driven economy. As we've seen, it's actually it has the highest difference between consumption and exports. So it is negatively impacted by a weak currency, which is what we've seen recently. It makes the cost of imports rise. On the flip side, you see some of these other countries, some of the more traditional exporters. You see China, the UAE, Vietnam, Thailand, etc. Their emphasis on a weaker currency makes sense, right? Because they want their exports. They care more about their exports being competitive than they do importing cheap goods. So we actually have the largest gap between consumption and exports. So we are really consumer dependent. And this is the last slide here. I've used this slide before. So if the US wants to strengthen its manufacturing capabilities, why doesn't it just try to weaken its currency, right? Because that's what we've been talking about. If we want to make our exports more competitive, then we should just weaken our currency. Well, it comes at a cost because stronger consumption is synonymous with stronger GDP growth. So in this chart, the size of the bubble equals GDP growth. And so as you can see, usually the bubbles are on the right anyways, because when personal consumption is up, generally it is. We don't see a lot of times where personal consumption is decreasing. But if you look at the bottom right as well, that's also when US net export growth is falling. And this makes sense, right? Because consumers are probably going to be consuming more when import prices are cheaper. And when import prices are cheaper, that generally means our exports are going to be less competitive based on the dollar dynamics. But what I want you to notice is the four unfilled big circles on the upper left-hand side here. What do we see here? Those are periods of time where the U.S. personal consumption is falling and export growth is rising. And the unfilled actually means negative GDP growth. So typically, in periods where our exports are getting more competitive and we're exporting more, that weighs on the U.S. consumer. And those are the times where we've had our biggest contractions in GDP. So we could be undergoing this long shift where we want to have a weaker U.S. dollar, um, you know, maybe more selective tariffs than the more broad range tariffs that we're seeing right now, in an effort to make manufacturing more important in the U.S. However, that will come with some pain, as we can see from this chart. It will make our import prices more expensive. And generally speaking, the US does not do well when that occurs. That's going to be it for today. I hope you guys enjoyed this video on the US dollar. Have a great week, and I will see you here next week for another Macro Monday video.